Hi, y'all. I'm John Rotonti, a portfolio manager at Bastion Fiduciary and one of the hosts of Rebellious Allocations, which is our Bastion Fiduciary podcast. The date is April 23rd, 2026. Today, I'm joined by Nick Lieb for a business deep dive into Cintas, ticker CTAS. Cintas is a stock that I own in the industrial and infrastructure portfolio that I manage at Bastion Fiduciary. Nick is an equity analyst covering industrial companies at Morningstar, and there's a lot of overlap between his coverage universe and the high quality universe I focus on at Bastion. Nick has been on the show twice before to discuss Vertiv, ticker VRT, and Eaton, ticker ETN, two companies that I own in the industrial and infrastructure portfolio that I manage at Bastion Fiduciary, and two companies that are central to the AI factory build-out, and in Eaton's case, the broader infrastructure and electrical grid build-out unfolding around the world. So if you haven't listened to those two episodes yet on Vertiv and Eaton, they are two of my favorite episodes, and I hope worth your time. Anyway, Nick, welcome back to the show.
Thanks for having me on again, John. Pretty excited to talk about Cintas today. It's a company I've researched for over 7 years at this point, and it flies very far under the radar, even with the exceptional shareholder returns that it has produced.
Yeah, I can't wait to dive into this one too. But before we jump into the questions, I want to give some very high-level company statistics so listeners get a gauge for the size and scale of Cintas's business. Cintas has a market cap of about $70 billion and net debt of about $2.7 billion. So its enterprise value is approaching $73 billion. In the last 12 months, Cintas generated revenue of about $11 billion and net income of about $1.9 billion, which is a net income margin of about 17.5%. It generated operating income of nearly $2.5 billion, so its GAAP EBIT margin was 23%. Cintas grows organically and through acquisitions as it systematically works to consolidate a fragmented industry. In the last 12 months, Cintas generated operating cash flow of about $2.2 billion and spent about $414 million on CapEx. So its free cash flow was about $1.8 billion, which equates to a free cash flow margin of about 16% and free cash flow conversion on GAAP net income of 93%. Over the last 5 fiscal years, even if we subtract acquisition spend, its free cash flow was positive in each year, and its free cash flow margin never dipped below 13.7%. And its free cash flow margin after acquisitions over the last 5 fiscal years averaged 15%. Cintas generates returns on equity in the 35% to 40% plus range. So this is a very high quality business that I'm super excited to learn more about from Nick Lieb of Morningstar. On to those questions, Nick. Can you give us a brief history of Cintas and any important milestones or inflections in the corporate history?
So before it was renamed Cintas, it was called Acme Industrial Laundry Company, which was founded by Richard, or he went by Doc Farmer, in 1929. And believe it or not, the Farmer family is still deeply involved in Cintas operations today, nearly a century later. So to help set the scene, in the early to mid 1900s, there was a ton of industrial activity going on in the U.S., especially in the Midwest. And Acme started out washing dirty rags and reselling them to factories in Ohio. And Doc's son, Herschel Farmer, took over that small business in 1940 and expanded their service into shop towels and some other reusable, cleanable linens. And it wasn't until 1959 when Doc's grandson, who is also named Richard, but he goes by Dick, took the reins of the company and entered it into uniform rentals, which has remained its core business ever since. And Dick also established the company's incredible culture in a lot of ways, and made Cintas' first acquisition in 1965. And the uniform rental industry was comprised almost entirely of small mom and pop shops at this point in time. So acquisitions were and still are a strong source of growth. And so Acme's name was changed to Cintas in the early 70s. And at that point, the company was expanding across the US. But it wasn't until 1992 that Cintas entered into some adjacent facility services, the first being floor mat rentals, then first aid and safety equipment, then fire protection, and finally commercial kitchen and bathroom products and services. So in 2004, Scott Farmer, who is Doc's great grandson, became CEO and continued the same strategy of basically organic plus inorganic growth. And somewhere along the way, Cintas entered into document shredding, but it sold that business around 2015. And at that point in time, Cintas had very much cemented itself as the largest uniform rental provider in the US. So then in 2017, it acquired its fourth largest competitor, G&K Services, which gave Cintas an even larger scale lead over competitors. So fast forward through many more years of exceptional growth to today. Scott Farmer remains the executive chairman, and the Farmer family owns around 14% of Cintas. And last month, so March of 2026, Cintas announced its long sought after acquisition of the third largest uniform rental company called UniFirst.
Yeah, 14% ownership by the Farmer family. That's strong. We're definitely going to get into that announced acquisition of UniFirst later on. So you mentioned some of the products and services that it provides its customers. Can you please briefly describe the business model, the different business segments, and the variety and the number of customers and the different industries that Cintas provides services to?
Yeah. So pre UniFirst acquisition, Cintas consistently noted that it had over 1 million individual customers. So if the acquisition goes through, it's probably going to have around 1.5 million. And so I touched on some of the services that Cintas offers to its customers. It buckets them into three business segments, and it calls its largest segment uniform rentals and facility services. So, at risk of sounding obvious, this segment tailors, rents, and replaces uniforms, branded mats, and other linens. It also restocks cleaning products, so things like soaps, detergents, mops, and trash bags. And then it offers actual cleaning services like carpet deep cleanings, drain maintenance, and kitchen equipment sanitizing. And this whole segment is around 80% of Cintas' total revenue, and half of that 80% comes from uniform rentals alone. And it bundles its services together and tends to start the customer relationship with uniform rentals, which generally involves a 5-year contract with price escalators, so that Cintas can recoup upfront uniform creation costs and fixed costs like its laundering equipment and trucks. And its second segment calls first aid and safety, which is around 12% of revenue. That encompasses first aid replenishments, so items like bandages and antiseptics, and then personal protective equipment rentals, things like AEDs and eye wash stations, and then training for customer employees to safely use all of these things in the event of a medical emergency. And lastly, it has a fire protection services segment at around 8% of revenue, which involves the testing, inspection, and maintenance of fire extinguishers, alarms, sprinklers, emergency lighting, and exit signs. The majority of services in these two smaller segments don't have contracts, but a few lines like AEDs and eye wash stations tend to have 3-year agreements. And it has a very small direct uniform sales business that has shrunk over time to around 3% of sales. And today, it's more so used as a way to get skeptical prospective customers to rent uniforms. And margins for each of its segments outside of this direct uniform business are all quite similar. I estimate they produce low to mid 20s operating margins. And Cintas doesn't break down its revenue from an end market perspective very often, but what I can tell you is that around 70% of sales come from service industries like restaurants, hotels, museums, airlines, universities, retail stores, and hospitals, while the goods producing industries, so that's like construction, manufacturing, oil and gas, and mining, that accounts for 30% of sales. No industry makes up more than 10% of Cintas sales.
Really good business overview there. Um, I think around 60% of new business is with customers who are not currently on a rental program. I think Cintas calls them non-programmers. What does that tell you? What is the opportunity for Cintas from these non-programmers?
So I think this is a good opportunity to explain Cintas value proposition to help contextualize why businesses choose to outsource these kinds of services. If you look at Cintas' main customer cohorts, especially consumer facing industries like hotels and restaurants and airlines, cleanliness and safety are required to maintain brand image and regulatory compliance. But keeping employees and facilities clean and safe involves a ton of moving parts to manage in house. Think about all the frictions that can be alleviated if a large hotel chain gives up managing its own uniforms and first aid equipment. A hotel needs staff for positions like the front desk, security, cleaning, maintenance, and in the kitchen. And each of these positions has relatively high employee turnover, and they might require completely different uniforms from one another that all have to be crisp and clean every single day of the week. So designing and maintaining uniforms for every single employee can quickly become super hard to do consistently, especially if the supplier randomly changes a specific design or fabric type. And that supplier doesn't launder uniforms, so the hotel either has to do it in-house or hope that their staff do it at home. And for first aid equipment and supplies, they have to be constantly monitored and replenished. But safety regulations change, and the person in charge of monitoring the supplies and training employees might quit. So you can see where I'm going with this. These functions are very critical to run a hotel, but they're strangely complex and by no means the hotel's main focus. So handing these responsibilities over to Cintas ensures that a reputable expert is in charge of maintaining these fast moving but critical items. And it also alleviates a significant burden for employees, which allows them to focus on their actual job. A similar story can be told for goods producing customers. Intact hard hats, vests, boots, and gloves are all critical for construction worker safety, but leaving their care in the hands of employees or the construction company itself is just fraught with errors. So not only can outsourcing implicitly save many multiples of what Cintas services cost, but because Cintas has dominant leading scale, it can offer all of its services at a small fraction of what they would cost an individual customer to perform in house. And so, in terms of the white space opportunity, I think the new customer pool remains quite vast for Cintas. I can't really give you an accurate penetration figure, but in general, I believe the majority of businesses in many of Cintas' target industries still manage their uniforms in house. And that is especially true for industries like welding, pharmaceutical manufacturing, and then healthcare, where non surgical doctors and nurses are in charge of cleaning their own scrubs, and operating room garments are laundered by the hospital for the most part. Now, for Cintas other services like sanitation or first aid supply management, outsourcing penetration is arguably murkier, but I believe an even greater majority of businesses still insource most of these functions. And something I can touch on later this episode is that a lot of these potential customers already sit on or near existing Cintas truck routes.
Yeah, pretty clear value proposition when Cintas can offer the services at a fraction of the cost it would cost that customer to do it in-house. So that's a pretty clear value proposition. Can you please discuss the competitive landscape? What is Cintas's market share? Who are the main competitors? How concentrated or fragmented is the industry? And are the main players in the market generally rational when it comes to pricing?
So I would say it's also quite an erroneous exercise to try to calculate market shares. My best estimate is that Cintas holds just under 40% share of the outsourced uniform and facility services market. And that is before the UniFirst acquisition. But keep in mind, there are hundreds of private competitors, and the third-party research firms that provide TAM estimates include or exclude all sorts of different services in their calculations. So what I can tell you with much greater confidence is that Cintas generates around 4 times the revenue of the second largest competitor, which is called Vestis. And it will grow to over 5 times if the UniFirst acquisition goes through. So those hundreds of competitors that make up the rest of the US market are smaller regional players, like a company called Alsco, and then local mom and pops. Anecdotally, I'm based in Chicago, and if you pay close enough attention here, you'll notice a ton of mom and pop laundering facilities and trucks still scattered around the city. So something that I'll briefly mention is that this industry is all about route density. There are extremely high fixed costs required to enter the uniform rental business. The average laundering facility can cost upwards of $20 million. And then you obviously need trucks and people. So if a company has built out a dense facility network that already services most of the potential customers on a route, the economics to enter that market can be extremely unattractive. And so this elicits quite stable market shares and pricing behavior all the way down to a local level. But you mentioned that around 60% of Cintas new business comes from quote unquote non-programmers or customers that choose to outsource for the first time. So the remaining 40% or so actually comes from Cintas taking customers from competitors. The industry can be pretty cutthroat, and I can get into how Cintas does this.
Yeah, we'll definitely get into that. Cintas has revenue equal to 4 times its largest competitor, the second largest player in the market, and that may go to 5 times, as you said, if the UniFirst acquisition goes through. That's pretty impressive scale there. You rate Cintas as having a wide moat. What are the sources of its moat, and why do you think it's sustainable for 20 years?
Cintas benefits from a clear cost advantage by having the greatest scale and the densest routes, and then from switching costs that are driven by all of the frictions a customer experiences if it wants to change outsourcing partners. So, from a scale perspective, Cintas aggregates its customer orders to procure supplies at the lowest cost in the industry. All the way back in 2009, Cintas mentioned its infrastructure at the time reached around 95% of the workforce in the US and Canada. And it's a lot bigger today and has gained a lot more sales volume within that infrastructure. And products like mops, mats, towels, and uniforms can be manufactured using the same raw ingredients and in a lot of ways cleaned using the same assets. So that gives rise to significant economies of scope as well. And at the same time, Cintas has over 12,000 routes, with far and away the greatest route density in the industry. And so this means it has the most customers and the most revenue spread across its facilities, trucks, and employees, which enables Cintas to undercut competition when it needs to, or to generate the highest margins if it takes market price. And it tends to do the latter and actually oftentimes charges a premium. So, as a result of all of the aforementioned factors, it generates over triple the operating margin and return on invested capital than Vestis and UniFirst. And I think that price premium combined with Cintas industry best customer retention rate are evidence of superior service. Logically, customers want the best service because if it's bad, they lose more money than the premium Cintas charges. And Cintas services at first glance are simple, but if you actually dive into its operations, they're quite complex. And if a service provider messes up and can't account for errors, customers just leave. So, although we don't categorize things like service quality or corporate culture or a digital tool suite as actual moat sources on a standalone basis, in aggregate, they are a huge differentiating factor for Cintas, and I can get more into each of those as we move through our discussion. Now, once a customer is onboarded, I think switching costs can form and then grow as the customer adopts more services over time. And switching costs are probably weak for small customers, but they become quite prominent for larger national customers that demand uniformity across their entire brand. Think about a national restaurant chain that says it has, let's say, 100,000 employees. That Cintas, it manufactures and maintains tailored uniforms for all of those employees, branded entrance mats, and then it, rents out first aid equipment and trains employees. And let's say it deep cleans all of the restaurant's kitchen equipment as well. Switching vendors really only makes sense if the cost savings exceed the sum of explicit costs like uniform retailoring and contract termination fees, and then implicit costs like service disruption and the risk of inconsistent or lower quality uniforms.
I like how you
And
distinguished there can be switching costs can come both in forms of explicit and implicit. And then, in the previous question, we learned that Cintas's revenue is 4 times the number 2 player. And in this question, we learned that Cintas's operating margin and return on invested capital is 3 times the number 2 player. And it has operating margins triple the company that it's trying to acquire in UniFirst. So that's pretty impressive as well. You mentioned customer retention is the highest in the industry. What is Cintas's customer retention rate? And would you describe any of Cintas's revenue as recurring in nature?
so, very simply on recurring revenue, I view pretty much all of Cintas revenue except for its one-time uniform sales as recurring.
Wow.
Again, uniform rentals are delivered on a weekly basis, and they have 5-year contracts, so very predictable, very visible revenue. And most of its other services are frequent and non-discretionary in nature. And so, in terms of customer retention, Cintas local and regional customers, which are around 3/4 of its revenue, retain at around 91%. And then retention of its national customers, which is the remaining quarter of revenue, is 99%. And these figures don't account for growth, so I guess you could call it gross retention. Cintas' national footprint is a pretty big factor here. So those larger customers, they want uniformity across their business. So regional and local competitors simply tend not to win that business. But in terms of that kind of like lower retention for smaller customers, I believe most of that attrition is actually from business closures, not actually Cintas losing the customer to a competitor. But overall, this equates to around 95% gross retention each and every year, which means customers tend to stay around 20 years. And 2017 was the first time, to my knowledge, that Cintas disclosed 95% retention, but I suspect it has maintained this level of retention for at least a few decades. So on top of the superior service and switching costs that I outlined earlier, another huge retention factor is the intimacy and specialization Cintas forms with its customers. Its truck drivers, which it calls service sales reps or SSRs, visit customers on a weekly basis, and they get to know them quite well over time. And Cintas is big enough that a lot of its SSRs specialize by industry, and they effectively become consultative experts who identify efficiencies that Cintas can unlock for the customer. And the company is meticulous with recruiting and very quick to determine if someone will make a good SSR. So the bottom line is that these driver customer relationships, many of which have developed over decades, by the way, represent a less obvious switching cost as each party becomes more familiar with the other over time.
Nick, what are the drivers of demand and organic growth for Cintas and the rest of the industry?
Yeah, so Cintas benefits from a few really strong secular trends. So first, safety and quality regulations are on the rise. They're becoming stricter and more complex to comply with over time. Concurrently, a skilled labor shortage has formed because not enough new talent is replenishing retiring workers. And this is in my opinion, a direct result of falling fertility rates, coinciding with vast swaths of baby boomers and now Gen Xers reaching retirement age. And throw in the fact that employee benefits are being upwardly pressured, and younger people are tending not to stick at the same job as long, and you get rapidly rising costs of labor. And so all of these factors combine to form a giant mess for companies to manage these functions that are not even in their wheelhouse. And so I think this is why Cintas has been able to win so many new customers through time. And another reason why customer retention is so high. Companies are like, oh my gosh, remember all of the problems we had when we used to do all of this in-house. We're saving so much time and so much money with Cintas that we're never going back. And then there's cross-selling. So once a customer sees the savings from outsourcing one function, they tend to adopt more services from that same provider. And because SSRs interface with actual customer employees on a regular basis, they can very easily identify customer pain points and recommend new services. And I think there's a pretty massive runway for Cintas to continue to win wallet share. In 2017, Michael Hansen, who was the CFO of Cintas at the time, said that out of all of Cintas customers that rented uniforms, 60% rented entrance mats, and fewer than 20% used any other service. So consolidating vendors is yet another stress reliever for customers, and Cintas has introduced a number of new services since 2017, and I think it can absolutely continue to identify more.
What percentage of sales is generated in the US versus outside the US?
To my knowledge, Cintas last mentioned a geographical breakdown around 2013, and said sales outside of North America are in the 2 to 5% range. So I would venture to guess that it's still in that range.
Is growth and expansion outside the US part of their plan?
Not currently. The US market is sufficiently large and growing, so much so that Cintas doesn't need to risk geographic expansion yet. And I say risk because different countries come with different sanitary practices and regulations and supply chains. And Cintas has nearly a century of knowledge and experience in the US. That being said, if it were to expand internationally, management has noted that Cintas would follow its multinational customers that have similar practices and kind of that uniformity between jurisdictions.
That makes sense. You mentioned that the uniform contracts are typically 5 years in length with price escalators built in. But let's talk more about pricing power. How often and by how much does it typically increase prices?
So price increases are historically around 2 to 3% per year, but the timing definitely varies. For their contracts with built-in price escalators, it's obviously far more predictable. But for services without an agreement, it can be pretty sporadic. So in terms of pricing power, I definitely think Cintas has it. There's a few pieces of evidence, in my opinion. One, it charges a premium for its services, but customers still retain in the high 90s.
Mhm.
And then two, it maintains high and rising gross margins that have not really taken a hit during global economic downturns. So higher prices, higher retention, and greater profitability than competitors. And as another strong line of pricing defense, Cintas services are what I like to call low cost mission critical, meaning they're a very small percentage of their customers' expense budget, but without them, customers can't function. And so psychologically, this shifts the customer's focus away from price. And at the same time, its services save the customer many multiples of what they cost. Cintas bread and butter, which is the uniform rental, it costs around $1 per uniform collected. So if you look at, a 10% price increase, that's quite literally pennies.
Yeah, I've always thought about pricing power and how it can come in different forms. And one of those forms you just talked about, mission critical products that are a, low, very low percentage of the customer's overall budget. And I like how you phrase that. It psychologically shifts the customer's focus away from price. I really like how you phrase that. Thank you. Okay, let's dive into their acquisition strategy, Nick. Please discuss anything that you think is relevant regarding their acquisitions, such as how many acquisitions they make a year, what is the average size of an acquisition, how much these acquisitions typically add to the top line revenue growth each year on average, whatever you think is important.
Cool. Yeah. So around a third of Cintas revenue growth has historically come from acquisitions, with the remainder from organic sources. And so with these route-based service providers, I kind of view them like living organisms. You can like picture them on a map where the largest ones gradually gobble up smaller neighboring companies.
Like a
Uh,
blob. Yeah, like a blob. Yeah.
exactly. Yeah,
I like that.
exactly.
Yeah.
And so Cintas M&A strategy is exactly that. It generally involves acquiring small tuck-in competitors with a ton of operational and supply chain redundancies. And a good portion of an acquired company's customers actually tend to be absorbed into existing Cintas facilities, which can very quickly raise their margin profile up towards that of Cintas. So I'll use two acquisitions that Cintas made in 2024 as examples here. The first one was in Kentucky. Cintas bought a competitor there who was driving past 7 Cintas facilities on a regular basis. So Cintas kept one of their facilities and absorbed the remainder of the customer base into existing Cintas facilities. And the second acquisition, that was in Pennsylvania. Cintas didn't keep any of the competitors' facilities, but instead absorbed its entire customer volume into 16 existing Cintas facilities.
Wow.
And so this runway, the acquisition runway, I think it remains pretty abundant. The last estimate Cintas gave was nearly a decade ago. It was in 2016 when management mentioned that there were over 600 North American competitors within the uniform rental business alone. So that figure is probably smaller now, but it doesn't include any other services, which are arguably even more fragmented.
I love it when management teams or analysts can put synergies for me, like almost draw me a picture of what those synergies look like. Rather than just saying, oh, there's going to be 15 million. I'm making up a number here. There's going to be $15 million of cost synergies.
Right.
Telling me that they drive by, the company they're acquiring drives by 7 Cintas facilities or drives by 16 Cintas facilities. And Cintas only needs to keep one of those, or even none of those. Like really clearly paints me a picture of one type of cost synergy. So I appreciate that. Okay, so on to the UniFirst acquisition. Um, First of all, in your opinion, is the deal transformative? And then, second of all, do you think this deal is accretive to Cintas's intrinsic value per share?
I don't view the deal as transformative, but it's certainly material. So if the acquisition goes through, it will grow Cintas top line by around 20%. And the $5.5 billion purchase price, that translates to around $310 per UniFirst share, which represents nearly 40 times its earnings. Now, I mentioned that Cintas tends to lift acquired firms' margins up towards its own through eliminating redundant capacity and combining supply chains. So I think that's going to happen here. So even though that acquisition multiple looks high, it could quickly become attractive if Cintas, let's say, doubles UniFirst's net profit margin. And what it really does is it adds immensely to Cintas' national footprint and its scale. It can cross-sell to UniFirst customers and negotiate better supplier terms by being many times the size of any competitor or customer. So I do think the acquisition will end up being quite value accretive.
Yeah, just back to potential synergies. We talked about the cost synergies of taking out some of the redundant capacity, but there's also revenue synergies potentially in the form of cross selling, like you mentioned. What will the UniFirst deal do to Cintas's balance sheet and the share count? Will it maintain a healthy balance sheet if the deal is completed?
Yeah, so the acquisition is going to be funded using half cash and half Cintas stock. And that cash is being funded by some debt issues. So I expect Cintas net debt to EBITDA to grow to around 1.5 turns, and its diluted share count to grow around 3.5%. But because it's such a high quality business with mostly recurring sales of non-discretionary services, I think this level of debt is quite reasonable. Its pre-acquisition interest coverage ratio is sitting around 24 turns, so the additional debt will very roughly cut that in half, which is still quite healthy.
Yeah, I agree. So while we're talking about numbers, let's get to your model and your base case assumption. So over the next 5 years or so, in your base case, number one, at what rate do you think Cintas will grow revenue? Number two, do you expect any margin expansion? And if so, how much? And then number three, at what rate do you think EPS or earnings per share will compound over the next 5 years?
From all of the organic and inorganic growth sources I've outlined, I think 8 to 10% annual sales growth is quite realistic over the next 5 to 10 years. And this matches pretty well with Cintas' historical growth. And in terms of its margin expansion, I expect around 50 basis points of annual operating margin expansion that comes from quite a few levers. So, on top of the really strong economies of scale and scope I mentioned earlier, Cintas has some of the most tangible operating leverage in the entire public space. The formula is really simple. Add more services to existing customers and add more customers to existing routes. And what is so powerful about this growth strategy is that it strengthens Cintas route density, which is arguably its main competitive advantage. So the company's facility count actually peaked in 2017. And since then, revenue per route has grown 7.5% per year. And I suspect a bulk of that has come from that cross-selling and adding new customers along existing routes. Another related margin lever is that we've seen Cintas enter differentiated services over time that fetch higher margins. So things like clean room lab coats for manufacturing semiconductors, pharmaceuticals, medical devices, and aerospace parts. They require special cleaning methods and equipment that obviously has very high fixed costs. So again, a critical volume of customers is needed. And I haven't even mentioned Cintas' world-class ability to realize internal efficiencies. It consistently identifies facility improvements, supply chain efficiencies, and a ton of other small actions that reduce expenses and unlock laundering capacity over time. Its ESG reports are really fun to read, believe it or not, because they go deep into all the efficiencies that Cintas finds and then turns into tangible cost savings. And the last lever for margin expansion is what I like to call being downstream from technology, meaning Cintas uses technological advancements to take out costs and boost its growth. So an example would be Smart Truck, which is Cintas truck routing software that uses telematics and algorithms to optimize routes. Since it was introduced in 2021, truck idling time, so that's the time a truck is sitting in traffic or at stoplights or stop signs, that has declined by over 65%.
Wow.
And annual revenue growth per route has accelerated. So management has laid out that Cintas' most mature facilities generate over 30% operating margins. And I think with all of these levers, at least a high 20s margin is very achievable when management wants to get there. So in sum, high single digit top line growth, 50 or so basis points of margin expansion, throw in some opportunistic share buybacks, and that all translates to low teens EPS growth.
Yeah. And like you said, it's pretty predictable growth. Obviously, anything could happen, but there's a high, gross customer retention rate of 95%, and the vast majority of the revenue is recurring in nature. So there's a degree of stability and predictability to this business. I'll tell you, when you were going through that answer, my ears perked up when you said has some of the most tangible operating leverage in the public space. So that's a pretty good quality to have. So, what return on invested capital do you think Cintas can generate over the next 5 years or so? And what do you think the trajectory of ROIC will be? The reason I ask, does the Universe acquisition bring down the ROIC, or do you think ROICs at Cintas can grow over the long term?
So without considering the UniFirst acquisition, I model Cintas returns on invested capital rising into the low 30s over the next 5 years. However, UniFirst generates considerably worse returns. And if you look at it from a purchase perspective, UniFirst's operating earnings imply a roughly 3.5% yield on the price that Cintas agreed to pay. So my guess is that it will probably take a few years for consolidated returns to fully recover.
Yeah. As you said, the Farmer family owns about 14% of the shares outstanding. What role do they play, if any? And do you think Cintas has an ownership culture?
In my opinion, the keystone of Cintas' success is the culture that the farmer family has instilled for almost 100 years. Cintas employees have an incredibly strong ownership mentality, and that is by no means an accident. There's basically two things driving it. The first is a decentralized operational structure with stock ownership and profit sharing. SSRs are fully in charge of their own book of business. They earn commissions and bonuses for winning new customers and cross selling. And they're also compensated for passing along leads to coworkers. And so Cintas has some really strong company wide frameworks and procedures, but pricing discussions are between local managers and customers. And the second factor is, what I would say is a promote from within strategy. You'll see a lot of top management with really long tenure. Cintas current CEO, Todd Schneider, who has been at Cintas for 34 years. He joined right out of college. So when an executive starts out as, say, a frontline worker, they simply have a better understanding of how to please the customer and what makes the company tick.
Definitely.
And what's really cool is that managers actually ride on a customer route once per quarter and reflect on their findings. And this is a practice that Dick Farmer created and actually codified in a book he wrote called "The Spirit is the Difference," so that no one at Cintas becomes a stranger to customers. And I think all of this can be, partially reflected through Cintas' low workforce unionization rate, which sits around 2% versus over 50% for Vesties.
Wow.
And you could argue the decentralized nature of Cintas operations blocks the ability for unions to organize, but the alternative argument is that Cintas simply treats its employees well, so they don't need to unionize.
Yeah, you rate Cintas's management as exemplary, and I think you just hit on a ton of the reasons why you think they're exemplary. But is there anything else you want to add about management?
Yeah. So I would say shareholder returns really are a direct reflection of managerial decisions. A company can have a wide economic moat and a massive runway for growth, but if management decides to fire half the sales team or buy a massive unrelated business, the results are probably not going to be good. So in a lot of ways, superior returns come from a prolonged period of sticking to a logical set of decisions. Cintas, it just has an outstanding track record of reinvesting cash to create immense value for shareholders. And I think that is a direct result of its long tenured and customer focused team.
Yeah, so you say they have an outstanding track record of capital allocation. Cintas has increased the dividend every year since 1983, so that's 42 consecutive years of dividend increases. So can you please discuss Cintas's capital allocation? How do they prioritize allocating cash flow across CapEx, acquisitions, and then, paying down debt or increasing the dividend and buying back stock?
So, like I've mentioned, Cintas hasn't had to build new facilities for quite some time, but it treats internal reinvestment as its number one priority as it arises. It's still growing its truck fleet, and one of its ongoing focus areas is technology. Cintas has spent a lot of time and money building out a digital suite of tools for its customers and for its employees to use. It was super early to implement uniform tracking software, which has greatly reduced its error rate. And in my opinion, it's been a huge driving force behind its top tier customer retention. And so M&A is its second priority. Historically, it uses a mix of debt, equity, and internally generated cash to fund acquisitions. And like I've explained, it does a wonderful job at raising acquired firms' margins to justify purchase prices. And I think that this track record of success has made it the industry's acquirer of choice. Now, from a balance sheet perspective, Cintas tends to maintain around one turn of net leverage, which is very reasonable in my opinion. And it treats its shares properly. So over the last decade, it has opportunistically reduced its share count by around 13%. And so what remains of its earnings is paid out via dividends. Its payout ratio is around a third of earnings, and I think that percentage is fine, given the organic and inorganic growth opportunities ahead of it.
Nick, how cyclical is the business and how exposed is Cintas's business to a recession? Given that during a recession, typically fewer people are hired, unemployment goes up, consumers spend less on restaurants and hotels, for example, and fewer new businesses are formed. Or maybe a better way of asking this question is how has Cintas weathered recessions in the past?
So I would pretty bluntly say that Cintas marches to its own beat, barring a large scale global shock event. Those secular trends that I laid out earlier, so, rising regulations and costs of labor, those flare up during hard times. So companies actually tend to outsource non-core labor heavy activities more during recessions. And that acts as a counter-cyclical force for Cintas. Additionally, Cintas does a good job at capitalizing on downturns by gobbling up weakened competitors and maintaining proper spending to win customers when the economy recovers. And we saw this play out over the COVID-19 pandemic. Cintas revenue growth since 2020 has exceeded UniFirst's and Vesti's, and it cut a small number of employees at the outset of the pandemic, but then didn't record any employee terminations in 2021 or 2022. And I think another underrated aspect to Cintas resilience is the fact that it eats input cost inflation during downturns to help its customers. And again, I would say that is yet another thing Cintas does that supports industry high customer retention. So if we look back at its business during the '08 Great Financial Crisis, Cintas operating earnings dropped nearly 30% from peak to trough. Some operating deleverage there, but its ROIC stayed above its cost of capital. So if a global recession were to happen again, I think Cintas is actually better prepared today. It has diversified its services, entered into new non-cyclical end markets, and nearly doubled its operating margin since the GFC. That being said, these factors don't leave Cintas fully shielded. A lot of its end markets are still pretty cyclical in nature. So, if people stop going out to eat and construction slows down, some customers would certainly pare back spending on Cintas services.
Yeah, I think it was Warren Buffett that said you want to try to delight your customers every day. And I think eating input cost inflation during really difficult times for your customers is one way to delight them and build long term loyalty. So, rising oil prices have been top of mind for investors lately, and Cintas's business model relies on trucks and drivers. So, what percentage of its cost structure is fuel expense?
It's funny how little impact these global macro events have on high quality equities, but how much focus investors tend to put on them.
That is true. Yes.
So energy costs represent 1.7% of Cintas revenue.
Wow.
Cintas, like we've talked about, it has pricing power, so it could pass through rising fuel costs to the customer, which in this scenario, management has laid out it would be around 30 basis points. But To expand on what I just mentioned, Cintas historically uses its internal efficiency gains to offset inflation instead of relying on price hikes.
Yeah.
So even though I think that price increases are justified, as Cintas continues furnishing customers with top-notch service and expanding the value it offers, these small and frequent inflationary events are easily absorbed.
Can you please discuss the current environment and the current context in which Cintas is operating? Is the current environment favorable or challenging? And what does a favorable macro environment look like for Cintas?
I'd call the current operating environment business as usual. There's probably always going to be global tensions and input cost inflation, but Cintas has an incredibly resilient business, and I think it's well positioned to handle headwinds. Um, for reference, Cintas operating income has grown every year except for two since it went public in 1983, despite all of the wars and recessions and bubbles that have occurred.
Yeah, that's a heck of a record. And in one of your notes, Nick, you wrote, quote, the business has successfully fended off competition and sidestepped obsolescence for almost a century, end quote. So looking down the road, if robots and automation replace some human labor, is that a risk to the business model that you think investors should be considering? Or do you think Cintas's business can remain as relevant and as in demand as ever?
I've thought about this a lot. In my opinion, there are a few factors that help shield Cintas from the jobs that are lost to AI and robots. Most importantly, most of the jobs that are being lost are in white collar functions, which is not a customer base for Cintas. And for its actual customer base, the argument can be made that a large chunk won't be taken over by robots or AI. Consumers don't want to interface with a fleet of robots at an upscale hotel or restaurant. Um, Additionally, I believe a lot of Cintas services are still necessary even with robots in the picture. Kitchen and bathroom supplies still need to be replenished, and fire equipment still needs to be inspected. And in the coming years, I also think any decline in Cintas customer pool will be more than offset by new job growth and businesses choosing to outsource non-core functions. I'll use healthcare yet again as a great example here. It's going to have to see some strong job growth over the next decade, given our rapidly aging population in the developed world. Cintas claims that the healthcare market currently has 18 million uniformed workers, so the runway is pretty massive already, and I believe that is within the U.S. Now, over the very long term, my guess is that a significant percentage of human blue collar workers will be displaced by robots. Um, Management has compared this to late 90s offshoring. Cintas had at the time 70% goods producing customers, but it pivoted to service providing industries. And so that has actually flipped. So the timing and equilibrium saturation of automation, uh, to me, they remain giant question marks, but Cintas has a proven ability to adapt and plenty of time to do so. So, really, the bottom line is, do I think it's possible that all humans eventually become obsolete? Yes, there is a reality where that happens, but a more realistic outcome is that these tools will let people do their job better and labor will evolve.
Yeah, labor will evolve, hopefully. And on the other hand, do you think AI and robotics can materially improve productivity at Cintas, whether through improved routing or factory automation or in some other way?
I think AI and robotics are going to be a net positive for Cintas. I've mentioned some of its digital tools and automation initiatives that it's using to, save energy, reduce ordering errors, and identify cross-selling opportunities. And AI and robotics are very likely going to supercharge those.
What are the other risks you think investors should be aware of?
The biggest one would be a large change in its management team or operating strategy. Cintas is extremely people centric, so its employees are the lifeblood of the company. If it drifted towards centralized decision making or drastically changed SSR compensation, its growth algorithm could get derailed.
Nick, this was wonderful. Is there anything we missed? Is there anything you'd like to add to this dive into Cintas?
Yeah, I have one last insight related to incentives. So, Cintas does most things spectacularly, but it doesn't actually have a stellar executive compensation plan, in my opinion. Its annual cash incentives and long term incentive plan are based on two things, which is earnings per share and sales growth. I haven't found any direct incentive for management to control for margins or free cash flow or returns on invested capital. That being said, management is so disciplined and the culture is so frugal that this has not been a problem. But if the team decided to grow at all costs to meet these incentive targets and it did something like acquire an expensive unrelated business, that would be an immediate red flag to me. Um, I don't want to end on a negative note for one of the best companies I've ever come across. So, what I will say is that Cintas does hundreds of the small things right, day in and day out. You can't quantify many of them, but for a company to do this consistently through time and with tens of thousands of employees, I think it speaks to Cintas culture and the people that it chooses to hire. It's a company that saves other companies money. So it's B2B, doesn't have customer, product, supplier, or end market concentration. And it's not in a fast changing market. So I would call it a pretty low risk business. And if you combine that with a stellar management team and a wide moat that is strengthened by high and durable growth, you get a stock that consistently trades at a premium but still beats the market.
Excellent way to finish. Like you said, it checks so many of those boxes for a high quality, profitable growth business. Regarding the incentive compensation, I agree with you. And maybe, possibly, Cintas's management or board is listening in, and they decide to incorporate a return on invested capital metric into the compensation program. And then regarding the hundreds of small things that Cintas excels in and day out, that you talked about that are hard to quantify. Well, being hard to quantify and being idiosyncratic also means those advantages may be really hard to replicate. And doing the small things that matter dearly day in and day out consistently over decades, over a century, and building that into your corporate DNA, Nick, I think that's how compounding happens over a really long period of time. So thank you for that great conclusion, Nick. Nick Lieb, equity analyst at Morningstar, thank you so much for coming onto the show for a third time and sharing your knowledge on Cintas. I thoroughly enjoyed this discussion, and hopefully I can convince you to come back on the show again soon for a fourth time.
It was a pleasure, John. It's such a blast to talk about incredible businesses. So I'm always happy to come back.
Awesome. Thank you again.
Bastion Fiduciary is a fee-only SEC-registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions or personalized financial, tax, or legal advice. It does not constitute either explicitly or implicitly any provision of services or products by Bastion. All statements made regarding companies or securities are strictly beliefs and points of view held by Bastion or podcast guests, and are not endorsements or recommendations by Bastion to buy, sell, or hold any securities. Clients of Bastion or the host or guests of the podcast may maintain positions in the securities discussed in this podcast.